everyone, this is Abhijit Chatterjee. Welcome to our weekly session of Chartsarefun. This is the week of May 4th, recording this on Sunday morning, May 10th. We provide a blog site. It's at Substack, chartsarefun.substack.com. These blogs come out daily, so we appreciate you subscribing to it with your email. And when these blogs come out, you'll get them right as they come out in the morning. Our YouTube site is also Charts Are Fun. We do believe that there are tremendous insights in the charts, hence we call it Charts Are Fun. The key is to be able to use these insights in investment decisions, but we do not provide any investment advice because we are not registered investment advisors. We're not here to provide you investment advice. But throughout the videos and the blogs, you'll notice that what we share is technical insights, patterns in the charts, things that can be very, very interactive and exciting to be able to use in your investment decisions. Today, we're going to talk about a bubble kind of phenomena that we're seeing in front of us with the AI. This, as published by Bank of America last week, talks about the railroad bubble, which peaked in 1873. There was a panic selling at that point. We can see that panic selling from 1873. And then the next move again happened, and the next panic selling happened after 1893. But that phenomena of railroads took up 63% of the US stock market at that time in 1873. Let's move forward to the point when in the Nifty Fifties in 1972, that's when IBM, all these big, well-known companies, Polaroid, the idea there was you would just buy those companies, Coca-Cola, and you would never sell them. So it was a one decision market is what they would call it in those days. And then 1973, we had a crash. At that time, the Nifty Fifties were 40% of the S&P 500. So that tells you again the concentration of few set of stocks taking over the market cap of the broader index. Then came in 1990, Japan as part of the ACWI, which is the large and mid caps of all stocks around the world. This is not just like emerging markets, it's developed and emerging markets is what the ACWI ETF consists of. And in there, Japan took over 40% or 44% of that index in 1990. And that's the one that we see in orange. Dial up forward to another 10 years into 2000 when the dot-com peak happened. Cisco was the leader. It had the largest market cap at that time. 41% of the market cap was dominated by tech and telecom stocks. Yahoo, AOL, Cisco, you talk about all those internet.com companies and even Qualcomm at that time from a cellular mobile business with all the broadband, all the modems that they were selling was the hottest company. So was Nokia and many of the other companies as well. Tech and telecom took over 41% of that move. Now, what we're seeing in AI, take the Magnificent Seven companies. We know who they are. NVIDIA, the king right there. We got Microsoft. We've got Meta. We've got Google. We've got Amazon. We've got Apple. Take those Tesla. Take those seven dominating companies of the what they call as the Magnificent Seven, powering this AI move. Add three additional companies. Take Broadcom, which makes all the custom chips for Google, for Amazon, and others, the custom AI chips that they're being creating to compete with NVIDIA. Those custom chips are made by Broadcom. So take Broadcom, take Micron, the king of memory right now. There's a huge scarcity of memory. High bandwidth memory is what is needed to take the data out of the storage devices to pass on to the GPUs to feed the GPUs for all the AI workloads. Micron is absolutely shooting up to the sky. And the other like chip company, AMD. So take these 10 companies. Together, they're adding to 40% of the S&P 500. Talk about concentration risk. So this is what Bank of America is stating is there is, in terms of concentration risk, worries about a bubble forming. In this particular case, in 2026, we're talking about an AI bubble. What was the dot-com bubble in 2000? What was in Japan's case, the real estate kind of a bubble shooting up Japan in those days in the 90s. They also had Sony and all their big technology companies driving up that bubble as well. In Nifty 50 of the early 70s, 1972 was the peak, and 73 we got that crash. That was also a bubble right there with the Nifty 50 companies and then the railroads. So if you look at now, the key sector that has been climbing like no tomorrow is the semiconductor sector. And let's look at the daily chart spanned over the last 2 years or so. In the chart that you see, there is something called negative divergence, as in you hit higher highs in price, but RSI keeps weakening. That's a signal, call it a leading signal to a deeper pullback. So we got that into 2024 when we peaked from June to July. RSI was at a lower high, and then we got a pullback, RSI pulling all the way towards 30, and the SOX index pulled back to below the climbing 200 period moving average. Similar kind of a pullback came into more recently into 2025 when we moved from October to November, higher peak, lower high in RSI. That was again a leading signal of a pullback. And look at how much the RSI pulled back, how much the SOX index pulled back. And then this year, going into from January into late February, we can see higher high in price, but look at RSI at a lower high. Again, a leading indicator of a pullback. We can see the pullback came, and we came close to the 200 period moving average in late March. Didn't quite hit it. We came close to 7,084, and from there we climbed to 11,776. We're talking about close to almost 4,700 points, right? Out of 7,000, 4,700 points, almost 70%, right? If you take 70% of 7,000, that's like 4,900 points. We got almost 4,700 points, within 200 points of 70% climb in a very short period. But look at RSI. There is weakening signals as we're climbing higher highs in a very parabolic vertical fashion. RSI is weakening, lower high in RSI. MACD histogram is weakening, lower high in MACD histogram. So for us then to look into this on a longer term picture of the SOX index, we can see that in the dot-com period, take a rate of change. So year over year, percentage wise, how much had the SOX index climbed at that time? That went up to over 200%. This is rate of change 12 months over, the last 12 months into March of 2000 when it peaked. 200%. Where are we now? We are at 147.49, about 150%. So the 150% is 2.5x year over year as in terms of rate of change. We still could maybe, if you had to touch and repeat what happened in .com, maybe climb another from 150 towards 200 is possible, which means this could have some more of a vertical climb. But this just gives you a comparison of what happened in the .com period from a rate of change perspective, hitting 3x, and right now we are at 2.5x. Now, if you look at S&P 500 from a monthly chart, S&P 500, we can see these periods of consolidations, a peak, pullback, consolidations, and then the breakout. And we've seen this now over 3 periods since 2022. Of course, the low came in the COVID 2020 at 2191. From 2191, we climbed all the way up to 4800. 4800 came to 3500. Just below 3500 was the low in 2022 October. And then we based from 3500 to 48 and broke out. So 3500 to 48 is 1300 points. Add 1300 points to 48, you get 6100, which is where that peak was. So you can see how these peaks can be measured from the base of the depth of the base. So 35 to 48, 1300 points. Add 1300 to 48, 6100. Then came that next pullback that we got into the tariff-related pullback. 6100 came all the way to retest that 4800 level at 4835. Didn't quite hit 4818, but came pretty close at 4835. So 4835 to 6100, you're talking about roughly 1300 points. 48 to 61 is 1300 points. At 1300 to 6147, that's close to 74.50 or so. We've almost hit 74.01 last week. So another 300 or 400 points can get us there. But more recently, in what we saw from the February to January peak near 7,000, a pullback to 6,300. This was on a much shorter period, but that's how bull markets end. Bull markets go up and get shorter and shorter in terms of, we can see how this pace was much longer. This pace was relatively shorter, and this is even shorter. In a span of 2 months, we got a kind of a sharp pullback and then the climb back up. So 7,000 to 6,300, we're talking about 700 points. At 700 to 7,000, 7,700. If you look at Tom Lee, if you look at some of the other Wall Street pundits, they're all making claims of 7,700. When you have that much of smart money looking for a particular target, it's almost like an algo trading kind of a target that the market is moving towards. We could very much see that 7,700 target be met in the next few weeks for all that we know, because the momentum is incredibly strong. And perhaps that could be a target that we could see met. And if you look at the math, in the last three periods, every time that target has been calculated, that has been met. 48 to 35, 1300, added to 48, 6100, target got met. Pull back to 61 to 48. 48 to 61 is again, in this case, 1300 or so points. 1300 to 61, 7400 is almost met. We see 7400. Now 7000 to 6,300. That's 700 points. Add to 7,000, 7,700. That's where we think potentially this could be headed. Now let's look at small caps. These we know as the S&P top 500 companies. What is the small caps telling us? Small caps, interesting enough, in its weekly chart had an inverse head and shoulder. So in this inverse head and shoulder, we can see around the 225 level as the neckline. The head was formed at that 2025 April low at 169. So 169 to 224, add that up, you get close to 279, because 169 to 224, you're talking about roughly 55 points. Add 55 to 224, 279. We've already crossed the 279 and we are now near 287. Potentially, what this could climb up to is, if you look at the similar kind of a level of 271 to 240, that's 31 points from where it broke above 271. So the 31 to 271 is 302 is where we think this could head. That said, there are some warning signs. RSI is kind of at flat line at about the same level as where it was. MACD is showing negative divergence, and as the small caps are moving higher, declining volume. And so much with the accumulation distribution line at a lower high. These are indications potentially that the small caps could be forming a key top once it reaches that round number 300 level. So expect we are at 284, another 16 to 17 points of upside. But then from there, maybe 5 to 6% move. And from there, be careful, because with this negative divergence, we could be hitting a top in small caps. Now, the technology heavy NASDAQ 100 index, this has what we call in technical terms here, this is kind of a right angle broadening triangle pattern. This right angle broadening pattern, right angle because the resistance level is flat at 635. The two double tops at 635. One was in October, one was in January. That's 635, and then it pulled back from there to 555. 555 to 635, we're talking about 80 points. At 80 to 635, 715, 716. Negative divergence as this is forming. Negative divergence in the MACD histogram and in RSI. So that's almost there. We touched, if you look at the highs, 711 was on Friday. We closed near 711. So another 5 points and we could be hitting that QQQ target in the span of next few days. Now, a key pattern that is really worth noticing is smart money trades volatility futures. So when you've got to look at volatility of the NASDAQ 100, which is called VXN, what has smart money been doing? As QQQ is climbing, we can see this vertical climb. Smart money is not taking VIX down to lower lows. If any, VIX bottomed out in early May, and from there it's a W-shaped pattern with two bottoms in VIX of the NASDAQ 100 at 21.1 and 20.97. And look at the MACD on the signal line is now crossed above the red line. So this is a bullish MACD cross. MACD histogram is above the zero line. And this could pan out where on Friday, when this is a daily chart, by the way, on Friday, when NASDAQ was moving higher, look at VIX, it was positive. VIX for the NASDAQ, it didn't break down. It's stubbornly holding above the lows of last year. December, we saw 17, we saw 16 and a half in the August. Forget the spike. This was just an intraday kind of a spike. But if you look at 16s to the 17s, we are holding at a much higher low in the 21 level, indicating higher volatility is ahead. So while, yes, there is some upside in the S&P to 7,700, QQQ's almost met its target from its upside at 715, 716. Got to be careful in what the VIX is telling us is there could be some volatility coming with some kind of a correction in the next several weeks. Now, as the market moves, this S&P 500 moves to 7,700, there's one area that has already had its correction, but could be setting up for a reversal play higher. So this could be an opportunity to consider rotating out of the hot semis into a sector that could see some upside. And that sector is nothing but the sector that got hit hard, the software sector. It's got an ETF called IGV. Look at the top holdings. Oracle, Microsoft. Oracle is at 9.6% of IGV. Microsoft is number 2, Palantir number 3, Salesforce number 4, and Palo Alto Networks number 5, a big cybersecurity firm. So we're going to look at first the chart of IGV. What is it telling us? Beautiful cup and handle. 89 was a key level that from the left and the right brim. It pulled back from there to 74. Just broke higher at it closed above 91. That cup and handle from a 74 to 89 is 15 points. Add 15 to 89, you get 104. That's where we think the IGV, the software ETF, is headed. So it's something worth considering, rotating out of semis into software to play this upside. Look at Oracle. Oracle's got a beautiful double bottom at 134. Tested it twice. As it tested it twice, look at RSI. Beautiful positive divergence, higher lows. That's how a bottom forms. So now, if you look at 184 to 134, like two double bottoms and back to 189, 134 to 189, and then that breakout higher, that's a cup and handle. If that cup and handle pans out, 134 to 189, we're talking about $55 or so. Add that to 189, you get closer to 244. That's where I think Oracle initially could find resistance at the 208 level, because this double bottom, W-shaped double bottom from 134 to 171 measures a 208. So 208 is where its 200 period moving average is. It could hit some resistance, but then if in the June timeframe the earnings is strong, expect this to break out and move towards the 244 is Oracle. Microsoft is not yet broken out of its cup and handle, but beginning to form that base, a cup, and then the handle hasn't broken out yet. The key level we are watching for Microsoft to break out is at that 433 level that we tested in that mid to late April. Once that breakout comes from a level at the low at 356 to that 433, we're talking about roughly 77 points or so added to this. That takes us to 511 is where Microsoft's upside is if we get this cup and handle breakout. So it was weak on Friday. It was down 1.34%, but this could fizzle out. But if Microsoft has its cup and handle, and that is what going to be, and Oracle continues higher, those are the two largest components, it would expect IGV to continue its breakout towards 104. So these are the top two stocks. Palantir, interesting enough, is forming a pennant shape. Join the lower highs, join the higher lows. This is converging to a point where a breakout could come. It could go either way. If you have Michael Burry, who is negative on Palantir, you expect this to break down. However, if it breaks higher, expect it to go back and test its 200 period moving average near 163, which is 162.4 is where it broke down from in March. So Palantir could have that pennant breakout. You can see positive divergence. When it tested a lower low towards 126 to 122, RSI was at a higher low. Similar to the Oracle chart. You can see that positive divergence. Same thing with Palantir. Beautiful positive divergence. So we could think that perhaps this could have an upside breakout on any other positive news, because they've been winning a lot of contracts from the federal sector. Any other big client kind of contracts could help this breakout towards that level. Salesforce, which has been hit hard, also positive divergence, higher lows in the RSI. Look at its ascending triangle pattern. 163 to 193 is the base of that ascending triangle. $30, add to 193, 223 is where we think Salesforce could break out to. So this is another breakout we are watching for. We're talking about Microsoft's breakout, not yet happened, but if that breaks out, goes to 511. We're talking about Palantir's breakout from this pennant, could go back towards 163, and we're talking about Salesforce breakout. If it breaks out, 193 goes towards 223. And finally, Palo Alto Networks already has had its breakout. Look at its two good days of volume, broke out above its key level. So this cup and handle was 189 on the left brim, came down towards a low near 139, hit 186. That breakout measures to 232 on the cup and handle. It's almost started to climb where it's almost hit 208 on Friday, another 24 points or so, and it gets to 232. We think the momentum is there. We think RSI is above 70, MACD is climbing. We think Palo Alto has got a good chance to meet the target in the days ahead. With that, our key message is we are saying that SOX is repeating what we did from a bubble perspective, the railroads into the 1873s into 1972 peak, and then the pullback in 73 was the Nifty 50s, the IBMs, the all the Polaroids, all those Coca-Cola, all those companies of those Nifty 50s. Then we got the Japan kind of peaking out in 1990. We got the dot-com peak in 2000, and now look at AI, similar kind of concentration risk at 40%. This is Bank of America's analysis. We can see the negative divergence precursors to sharp pullbacks in the semiconductor index SOX. We can see those, lower prints in RSI. We have a similar lower print in RSI as it's climbing. Be watchful, lower print in MACD, watchful of a SOX sharp pullback. Monthly chart says that rate of change wise, maybe it could climb some more. It had hit 200% in the dot-com peak of its rate of change. This is over a 12-month rate of change. We are right now at 147. Potentially, maybe if this craziness continues, maybe it could hit that. But we'll have to see. Given that negative divergence panning out on this daily chart, we'd be cautious for at least having a kind of a sharp pullback in the near term. S&P 500. It's got beautiful bases and breakouts. Three such things happened over the last 4 years or so. In each of the breakouts, the measured targets got met, 48 to 35, 1300 added to 4861, met that, then put back 65 to 48, another 1300 point breakout, 3100 to 61 is 74. We're almost there. We hit 74. Now we have 7000 to 6300, 700 point breakout above 7000, 7700. A target that Tom Lee is expecting, a target that Yardeni is expecting, a target that many of the Wall Street pundits are looking for. Perhaps that becomes a self-fulfilling prophecy with the algos getting the market to that level is what we are looking for S&P. Small caps from its inverse head and shoulder had a breakout target to 279 that it already met, but in a more recent breakout from 271 to 240, that's about 31 points added to 271, 302. Negative divergence in RSI, MACD, AD line, and the declining volume are red flags for us to be careful not to chase small caps too much from here. It's already at 284 to 302. You're talking about another 18 points or so. So it's maybe another 6 to 7% upside is left in this particular small caps ETF. QQQ, we feel that has a target from this broadening pattern that it broke out to 716. It hit 711, so it's within 5 points of that. Negative divergence in RSI and the MACD histogram means to be cautious on QQQ's upside. The key signal for QQQ to kind of be worried about is that while QQQ is going to higher highs, that's not the case with the volatility for QQQ, which is VXN. It has already bottomed out at a nice double bottom at 21. It is beginning to climb. Expect higher volatility in NASDAQ 100. Higher volatility usually leads with market selling off. So bullish cross on the MACD. We can see double bottom at 21. Expect that to happen. And we can see that it's much higher than the levels we saw last year at 17 and 16 and a half, indicating smart money is the ones that trade volatility futures are beginning to buy puts. Puts buying when it over exceeds it. Call buying is what causes volatility to climb. So NASDAQ 100, while prices are moving higher and smart money is selling into weak hands, be cautious about what volatility signals we are getting of a market pullback coming. A sector that could be a beneficiary of additional strength as the S&P climbs towards 7,700 could be software. These are the top components of software ETF, Oracle, Microsoft, and the ETF is called IGV. The top components are Oracle, Microsoft, Palantir, Salesforce, and Palo Alto. So we go through each of their charts. IGV has got a beautiful cup and handle measured to 104. It closed near 91. Another $13 or so for IGV to climb. Oracle's also got a double bottom and a cup and handle from 134 to 189 that measures to 244. Near term, it could hit resistance at 208, 209, and then from their pullback and then start the climb again is what we feel. Microsoft has got its beautiful cup and handle, has not yet broken out. It needs to break above 433 for the cup and handle to be confirmed. If that breakout comes above 433, it moves towards 511. Palantir, pennant shape forming, declining tops, rising bottoms. That breakout could take it back to test the key 200-day period moving average near 163. Salesforce has got an ascending triangle pattern. Its break above 193 measures to 223. Beautiful positive divergence indicating a bottom having formed at that 163 level. And Palo Alto Network already has its cup and handle breakout measured towards 232. It closed near 207. So another 207, 208 is what it touched. Another 24 points or so to climb to 232 is where we think Palo Alto Network is headed. Good luck investing. We'll talk to you next week. Thank you for listening.
We are not registered investment advisors and encourage our users to consult with their financial advisors before making investment and trading decisions. Nothing contained in our content constitutes a solicitation, recommendation, endorsement, or offer by us at Chartsarefun or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction.